All right, hey, good afternoon, everyone. It's 2:30 in the afternoon. Markets are closed. Had a pretty nice move in beans today. Wheat was two-sided, and corn was a little bit choppy as well. So let's just jump right into it here and take a look at what the charts are telling us against a fundamental backdrop that is kind of confusing to traders, I think. So let's take a look at what these things are telling us. Over here on the left, you've got our daily chart of December corn. This is 240 minutes, and this is 60 minutes, okay? And I think what you can see in here is an explanation of what we think the market is probably doing. First of all, we've got the big down move, right? You have a big up move followed by a big down move. And now we have a consolidation pattern. And generally, what follows consolidation is a period of continuation, right? Continuation follows consolidation. That's a general rule of thumb. And what's really got us worried about corn, honestly, is the 3 that's right here on this chart. We'd like to see that go away. This is not a confirmed wave 3 here because we're still inside the price territory of wave 1, but it's cause for concern and certainly could explain some of the exuberance that we saw to the downside. Now, what we think is going to come next, right, and that's the most important question that any trader can ever ask is, okay, that just happened, now what? So we want to look at our shorter term charts for a little bit of guidance there, okay? And I want to start with the 4-hour cloud. So first of all, this chart is a little bit bearish because we're below our cloud. I'm going to expand it here so you can see it a little bit bigger. And then I want to put our RSI and stochastic on here. So while we are a little bit bearish because we're below the cloud, we're seeing this sideways consolidation to absorb this big down move that we had, and we're doing so in a period of divergence on these indicators, on these lower indicators here too. Okay, so this marked the end to a wave A, and what should follow a wave A is a wave B followed by a wave C down. So the question is this B finished up yet? And is this 2 finished? And we don't think so, and here is why. Because if you look down on the 60-minute chart, which is the smaller time frame, right? What you'll start to see are some Fibonacci relationships. So first of all, this is an A, this is a B, and this would call for one more C wave back up. And remember, these waves should move in some sort of Fibonacci relationship with each other to help us identify what's consistent and what's not. So if we snap a Fibonacci retracement from the low that was set last week to the interim high here that was set, I believe, on Thursday. I believe this was Thursday. This was where wave B retraced to, which was 61.8% of the move, right? So that's a perfectly normal relationship for a wave B times a retracement. And then where we should expect is for wave C to fully retrace the wave A move and exceed it by some Fibonacci relationship, 31.8, 25%, something like that. So that would point to a target of up in here around the 514 mark. If you use complete proportionality, where wave C is equal to wave A, it would put us right in the 519 mark. And that 519 mark puts us nicely right at the top or right into the 4-hour cloud. And so right into here. So you could have a nice 1-2, a nice little move up. I don't know if that happens before the report or not, but if this is in fact going to turn into a bigger down sequence, then I think it needs one more up sequence to really kind of set the tone and before it rolls over. So a rally up here is likely to get sold from this type of setup, absent some sort of news or a balance sheet intervention that's coming from the USDA, right? That says, oh, hey, maybe we're not too bad. Because if you put in a 177 yield, let me just pull our balance sheet up here so you can see it. Okay, if we wrong spreadsheet. Hold on. That's the old one. Here's the new one. Cancel. Okay, so if we put in a 177 yield, okay, and the USDA decides to trim its balance sheet just a little bit and take out 300 million of demand, then we're sitting at a 2.5 billion bushel balance sheet, which isn't bullish. 17.2% of stocks to use, that's not bullish. We're going lower if that's the case. But if they trim it just a little bit further or maintain their demand, then we're really not that bearish. And so I think that they're probably more likely to leave demand where it is at 14,485 versus and pull the yield down a little bit less rather than pull the yield down more than anything else. So I think that we're looking at a balance sheet of around 2.1, which really isn't that bearish relative to what the rest of the stocks have been. So I think the shocking thing would be is if they drop the yield below 177 and or cut demand by too much. If you read the commentators out there and all the talking heads, they're going to talk about demand destruction and that the bushels are going to be there because of cool and wet temperatures and all that stuff. And that might very well be true, but I don't think we're going to go price all that in yet. I think we got to go a little bit higher and get a little bit of a news catalyst to push us lower. So we're short term looking for a rally in corn to replace hedges and put some more stuff on. Unless we get some sort of bullish surprise in there. But I think it's going to take something in the surprise category to really push us much higher. Now, the caveat to that is whatever's happening here in beans, right? Now, we know that the balance sheet's really, really tight. We've gone through that already, and beans may actually have to ration. And if that's the case, then we're going to blow through this, and we're going to blow through these old highs up here. And that's really significant because there are a couple of different counts. And, we read lots of different people. We listen to lots of different people, including different Ellioticians. And some of those Ellioticians are calling for a reversal to happen right in this 1425 area, and then for it to roll over and plummet all the way, down to the mid-10s. So that is a valid wave count. So I think the way we advance from here is super important in soybeans. If we're going to come up through here, we want to do it with an attitude, right? We want to do it with a lot of exuberance, and if that happens, then I think it's bullish corn. If we're able to poke through that, if beans are unable to rally on the news that they've had and unable to rally with exuberance, then I think that is leads to that more bearish alternative, which is a really bearish count. And I don't see how corn can survive a big bearish soybean move. And I don't see how corn can stay low if beans blow through the top. I think that this rising tide lifts all the boats in the grain complex. So, and there's a whole bunch of reasons why we think that, but let's just kind of keep it simple, right? So I think it's all eyes on soybeans to figure out what they're going to do and how they're going to react to that bullish action. This was a really nice little retracement level right here. And if we zoom in on this, you can see the short-term wave structure really clearly. You're 3 waves up from the low. You have a nice pullback in 4, and now you've got a move higher. You're back into the cloud, and this little short-term stuff did unfold in 5 waves. So you're looking for an A, a B, and a C in order to get bought before you go back up higher to challenge these highs and probably exceed them, right? So I kind of like the idea that we're going to break that and have to price in higher prices more so than the idea that we're going to come up here and the roll over and die and come lower. But anything's possible, and so that's why I think how beans behave coming up out of this cloud and how strong it is really, really important. I want to see a move like that, a big straight up vertical set of bars that just leaves no doubt in anyone's mind, and could pave the way for higher prices. But again, there is an alternative count out there that everyone needs to be aware of. So if we do break up higher, don't be surprised to see a hedge recommendation just in case, even though we may still want higher prices and be a little bit bullish. So we'll take that one day at a time, and we'll see how it needs to unfold when we get there. Okay, let's look at Kansas City wheat. Kansas City continued its issues today with just volatility, right? I mean, up, down, all around, no rhythm, no consistency. And if you wanted to trade this and you put a stop 2 or 3 cents under where you bought it, it's just immediately going to get filled, or worse, it's just going to gap your stop and run you. And so very, very difficult to trade, very light volume and very hard market. If you're going to trade Kansas City wheat, you really need to just put stops all the way down in here. But from our perspective, this is more bullish than bearish, just for the simple fact that that we have all these higher lows right in here, and we keep getting bought. And so I think eventually we're going to challenge the top end of this range, and we'll see how it behaves from there. If beans break, then I think wheat's got to go and corn's got to go. Watch wheat. It could end up being a sleeper here, and clearly a nice risk reward right here is risking the lower trend line right here below the cloud, trying to own it above that and hope for higher prices. That's clearly a play, but again, if you're going to trade wheat, be very, very careful, because it doesn't move in any sort of order or fashion. It's just volatile, and it gaps all over the place all day long. So be very, very careful if you're going to trade that. Okay, that's what we have for you so far this week. We'll see where we are tomorrow in corn, and if we're up a little bit higher ahead of the report, we may take some action, but otherwise we're pretty content watching and waiting for the report on Wednesday to see what the USDA does. Obviously that is going to be a news catalyst that will give the market something to feed on, and will likely determine the direction for the next 30 days or so. With that, there is always risk trading futures and options, and you should only do so in light of your own financial condition. Hope you guys have a great day. We will talk to you again on Wednesday or tomorrow if price action warrants it. Have a great night. See ya.